Good morning. Today is Friday, October 27th, 2023. Let's summarize the news. On the front page of the Wall Street Journal today, headline reads, Economy sped up in summer. U.S. economic growth soared during the summer, registering the quickest rate since 2021. The gross domestic product, GDP, experienced an expansion at a 4.9% seasonally and inflation-adjusted rate in the third quarter, which is more than twice the growth rate observed in the second quarter. This surge has been attributed to robust consumer spending, particularly in sectors like travel, concerts, and movies. Such expenditure has been buoyed by the strong labor market and savings from the COVID-19 era. However, several indicators suggest that this rapid pace might be challenging to maintain. People's savings diminished and inflation-adjusted incomes declined during the summer, potentially indicating a deceleration in spending in the future. Business investment has not shown significant growth. External factors such as escalating wars in Ukraine and the Middle East, potentially government shutdowns, and rising long-term interest rates may introduce economic vulnerabilities. Despite these challenges, the U.S. economy in 2023 has showcased remarkable resilience with earlier predictions of a slowdown not coming to fruition. Most economists now foresee an economic cooling rather than a full-blown recession. Consumer spending notably rose by 4% annually in the third quarter, a significant leap from the 0.8% increase in the preceding quarter. The Fed, observing these trends and other financial conditions, plans to maintain the current interest rates. They previously increased the benchmark Fed funds rate to counteract high inflation, which is now moderated from its peak in June 2022. While the current financial climate suggests a potential soft landing, that's a scenario where inflation subsides without leading to a recession, several concerns still persist. The U.S. 10-year Treasury note yield recently hit a 16-year high, which can influence borrowing costs and might decelerate the economy. Americans' post-tax income, when adjusted for inflation, dropped 1% in the third quarter, and their savings rate also decreased. This reduction in savings may impact consumer purchasing power in the near future. An increase in mortgage rates could suppress the demand for homes, impacting the housing market. Experts, including Andrew Hunter from Capital Economics, predict consumer growth might not be as robust in the upcoming quarter given the potential challenges from higher interest rates and other economic headwinds. She looks for a villain in property bust probe. China's President Xi Jinping is searching for parties to hold accountable for the country's property market crash. Investigations have expanded beyond the founder of Evergrande, a highly indebted property firm, to bankers and financial institutions that may have encouraged the speculative behavior of developers. Among those being investigated is a former head of the Bank of China, one of the nation's largest lenders. Xi Jinping has emphasized the importance of thorough investigations into the real estate industry, which once constituted up to a quarter of China's economy. He stated that he could accept slower economic growth due to the real estate slowdown, but emphasized the importance of an unrelenting fight against corruption. Experts have expressed concerns that these widening probes may divert attention from crucial efforts required to stabilize the suffering property market. The decline of China's property market has resulted in significant debt, rattled investors, and made consumers hesitant to spend. Evergrande's founder, Hui Ka-yan, was under investigation for possibly hiding assets abroad while failing to deliver homes people had already paid for. Another aspect of the investigation into Hui concerns potential illegal fundraising activities, which might have involved bribes to banking executives for loans. Videos showcasing Hui's luxurious life have become widespread on Chinese social media, indicating Beijing's intent to make an example of him. Liu Liangge, previously Bank of China's chairman, was arrested on charges of taking bribes and unlawfully granting loans. These charges are believed to be linked to the bank's lending to Evergrande. Evergrande's largest lender, China Minsheng Bank, is also under investigation. Despite being requested to list all its property borrowers, Minsheng failed to provide the data. Xi Jinping initiated a clampdown on the property sector in late 2020 due to concerns about a potential bubble. Consequently, Chinese developers have defaulted on over $120 billion of bonds. While there have been sporadic governmental efforts to support developers and stimulate home purchasing, a comprehensive plan for debt restructuring and aiding banks and stakeholders in taking losses is yet to be realized. Xi's guidance seems to favor a squeeze on the property sector, thereby limiting the success of policy recommendations. The financial strain on developers is hindering home sales and the beginning of new housing projects. projects. Concerns over Evergrande's financial situation recently incited a run on a small bank in northern China. Since taking office in 2012, Xi has utilized anti-corruption purges to strengthen his authority. The crackdown on developers like Evergrande has intensified investigations into major industry participants. Founder of FTX casts blame on lawyers. FTX founder Sam Bankman-Fried is on trial for fraud, money laundering, and other charges related to the collapse of his crypto exchange. In a notable departure from regular proceedings after the jury was dismissed for the day, U.S. District Judge Louis Kaplan had Bankman-Fried explain certain disputed subjects to determine what he would be permitted to say in front of the jurors. Bankman-Fried's main defense is that he relied on legal advice for several business decisions, including deleting communications and loaning money to himself. These actions, according to prosecutors, allowed him to commit the crimes which resulted in his exchange's downfall. However, under cross-examination, he struggled to recall specific interactions with the lawyers who supposedly guided his decisions. Earlier in the trial, 18 witnesses, including 3 former close associates of Bankman-Fried, testified against him. The judge intends to rule on the admissibility of Bankman-Fried's testimony soon. Prosecutors allege that Bankman-Fried assured FTX customers their deposits were secure and then illicitly used billions for personal luxury, risky ventures, and political donations. If found guilty, he might face a lengthy prison sentence. Despite the charges, Bankman-Fried has been proactive in defending himself publicly, maintaining a strong presence on social media platforms and frequently speaking with journalists. Taking the stand can be a risky strategy for defendants, as a perceived dishonesty can lead to a more severe sentence if convicted. Nevertheless, if Bankman-Fried can convince even one juror of his innocence, it could result in a hung jury and potential mistrial. During his testimony, Bankman-Fried explained that FTX used apps like Signal and Slack for communication, with some threads set to delete automatically after a duration. He insisted that he consulted lawyers about policies like message deletion. Yet when pressed about the specific interactions with these lawyers, particularly concerning the misuse of customer deposits, he was notably vague. The case is expected to go to the jury for deliberation next week. ECB follows Fed in holding rates steady. The European Central Bank (ECB) has decided to keep interest rates unchanged, concluding a series of 10 consecutive rate hikes. This decision comes as Europe's currency union is on the edge of a recession, with growing concerns about the global economy's stability. Notably, other major central banks such as the Federal Reserve have also put a pause on rate hikes, given the easing inflation from the previous year's high levels. There's anticipation among investors that these policymakers might shift toward reducing rates, especially as economic growth weakens globally except in the U.S. Several global factors are making these decisions complex for central banks. Israel's conflict with Hamas, the ongoing war between Russia and Ukraine, elevated energy prices, and a global rise in bond yields which could dampen growth and inflation. The ECB's deposit rate remains at 4%, marking a record for the institution since its inception in 1998. ECB President Christine Lagarde indicated that the Eurozone's borrowing cost might have reached their peak. This is attributed to previous rate hikes that are affecting the housing market and bank lending in the region. She also noted the weakening Eurozone economy, with the manufacturing sector's decline influencing other sectors. The Federal Reserve, in comparison, voted last month to keep rates steady, revealing some internal division on the future rate hikes. The ECB faces a more complex situation than the Fed. The Eurozone is experiencing higher inflation than the U.S., but its economic growth is substantially lower. Data indicates that while the Eurozone's economy might be contracting, the U.S. economy grew at 4.9% in the recent quarter. The ECB has to consider challenges faced by weaker economies in southern Europe, like Italy, which saw a recent spike in its 10-year bond yield. Inflation in the Eurozone dropped to 4.3% in September from over 10% in the previous year. This is in contrast to the U.S. inflation rate of 3.7% in the same month. Jason Davis of JP Morgan Asset Management noted that Eurozone's monetary policy seems to have a stronger impact than in places like the U.S. Germany, the leading economy in Europe, is witnessing a significant downturn. Factors such as high energy costs and a global shift to electric vehicles are impacting its dominant manufacturing sector. A potential risk for the ECB is inflation remaining above its 2% target. With energy prices on the rise and low unemployment rates across Europe, wages are projected to increase in the coming months. This wage growth can make it challenging to address inflation issues. U.S. loophole fuels rise of Chinese firms. A U.S. law allowing low-cost packages to be imported duty-free and with minimal customs checks have propelled the rapid expansion of Chinese e-commerce giants Shein and Temu. Packages worth less than $800 are permitted into the U.S. using a simple simplified process called the de minimis exemption. However, many U.S. businesses and lawmakers argue that Chinese firms are exploiting this loophole, importing potentially unsafe products of those made with forced labor and evading taxes. U.S. Customs and Border Protection recorded over 1 billion packages entering the U.S. through the de minimis exemption in the last fiscal year, a figure double that of 2019. Shein and Temu are estimated to be responsible for 1/3 of these imports. These companies attract American consumers with incredibly low-priced items like $4 t-shirts and $10 hair dryers. The massive use of the de minimis provision has been described as the world's greatest black market by Kim Glass, leader of the National Council of Textile Organizations. The popularity of Shein and Temu is impacting major U.S. retailers including Gap, Amazon, and Walmart. For instance, Amazon has observed decreased web traffic, and Gap admitted Shein was claiming more market share. Shein's monthly U.S. active users more than doubled to 30.2 million in the third quarter of 2023 from 2021, and Temu saw even more remarkable growth, outpacing Shein within a year of its inception. The majority of their products are shipped directly from China to U.S. consumers, with most orders falling under the $800 threshold, avoiding tariffs and border inspections. Both Shein and Temu assert their adherence to trade regulations and claim their success isn't solely due to the de minimis policy. The de minimis rule, which began with the Tariff Act of 1930, was designed to exempt U.S. tourists from tax on minor overseas purchases. In 2016, to ease the workload of customs officials, the limit was increased to $800 from $200. Although U.S. Customs hasn't revamped its regulations, it acknowledges the potential risk of harmful products entering due to the influx of low-cost packages. Changes to the regulation are now a top priority. The U.S.-China Economic Security Review Commission criticized Shein in April for potential health risks in their products' environmental degradation and several copyright infringement allegations. There have also been claims against both companies about the use of forced labor for producing their inexpensive items. Shein, for instance, has faced scrutiny over alleged sourcing of cotton from China's Xinjiang region, where Beijing is accused of using forced labor, a charge they refute. A U.S. law from June 2022 majorly restricts imports associated with that region. Both companies have denied the allegations, emphasizing their commitment to ethical practices. Now on to business and finance news. Sell-off in mega-cap stocks deepens. The Nasdaq Composite faced its largest two-day decline this year as a significant drop in major technology stocks continued. The Nasdaq index went down by 1.8%, the S&P 500 decreased by 1.2%, and the Dow Jones Industrial Average went down by approximately 250 points or 0.8%. Big tech shares rally has been impacted by recent quarterly earnings reports. Many tech giants reported third quarter results that did not meet investor expectations, leading to increased stock market volatility. The S&P 500's year-to-date gains have reduced to 7.8%. After surpassing Wall Street predictions in its recent quarterly earnings, Meta Platforms, formerly Facebook, saw its shares drop by 3.7% due to concerns about reduced advertising sales in the upcoming quarter. Alphabet's Class A shares went down by 2.7% after revealing underwhelming growth in their cloud business sector. Other tech giants such as Microsoft, Apple, and Nvidia also faced significant stock drops. John Lynch, CIO for Comerica Wealth Management, remarked on the high expectations placed on these major tech companies, which they have not met. The Nasdaq 100 index, which tracks the largest non-financial stocks on the Nasdaq stock market, entered a correction phase. This follows the Nasdaq Composite, which entered a correction on the prior day. As bond yields have surged, the appeal of megacap tech stocks has diminished. Notably, the yield on the benchmark 10-year U.S. Treasury note reached over 5% earlier in the week, the first time in 16 years, but retracted to 4.843% on Thursday. The U.S. GDP report for the third quarter showed a growth of 4.9% year-over-year, adjusted for seasonality and inflation exceeding economic predictions. This growth implies consumers are driving the economy and potentially avoiding recession. However, there is speculation about whether this growth rate represents a peak. This GDP growth has reignited debate about the Federal Reserve's plans regarding interest rate hikes. Other notable stock market movements include a drop in United Parcel Service (UPS) shares by 5.9% after reducing their sales forecast, and a decline in Comcast shares by 8.4% due to a loss of broadband subscribers. Conversely, International Business Machines (IBM) saw a share increase of 4.9% following positive profit and revenue reports. In the S&P, real estate was the top-performing sector with a 2.2% increase. Internationally, the stock's Euro 600 saw a 0.5% drop. However, Japan Nikkei 225 and Hong Kong's Hang Seng Index each experienced a 1.5% rise. Ford posts $1.2 billion profit, withdraws guidance for the year. Ford Motor reported a net income of $1.2 billion in the third quarter, marking a significant recovery from a loss in the previous year. However, the company has retracted its annual guidance due to the United Auto Workers strike's impact. Ford is adjusting its $12 billion planned investment in electric vehicles, highlighting concerns regarding consumer demand and competitive pricing. A second battery plant in Kentucky, partnering with the Korean battery maker SK On, will be postponed. The company's Q3 revenue increased by 11% year over year, reaching $43.8 billion, driven by robust sales of its profitable pickup trucks. The pre-tax profit for this period, excluding one-off items, stood at $2.2 billion. In contrast, Ford experienced a loss of $827 million in Q3 of 2022, mainly due to charges related to the termination of its autonomous driving venture, Argo AI. The company's adjusted earnings per share of 39 cents for the quarter were below analyst expectations of 46 cents, leading to a 4% drop in stock value during after-hours trading. After prolonged negotiations and strikes at 3 factories, Ford reached a provisional labor contract for its 57,000 hourly U.S. workers, effectively ending the strike and facilitating workers' return. The strike and the upcoming labor guidelines prompted Ford to suspend its pre-tax profit guidance for 2023, even after previously increasing it to between $11 billion and $12 billion in July. Ford estimates the strike to have cost roughly $1.3 billion in adjusted earnings across 2 quarters, with $100 million lost in the recent 3 months. Despite the financial implications, Ford Finance Chief John Lawler remains optimistic about the company's profitability. The proposed labor contract pending member approval promises workers a 25% salary hike and the reintroduction of cost of living adjustments. This contract is anticipated to add approximately $1.5 billion to Ford's annual labor expenses. Company executives cautioned that escalating labor costs could hamper competitiveness, especially when compared to competitors like Tesla without unionized workforces. This comes as Ford is intensively investing in its EV sector. As per Wells Fargo, by 2027, Ford's labor cost per hour inclusive of benefits is expected to reach about $88, considerably higher than foreign automakers' average and Tesla's cost. Amid a burgeoning EV market, Ford, like many other car makers, is apprehensive about the market's future and consumers' willingness to invest in the technology amidst growing competition. In the first 3 quarters of the current year, Ford reported a $3.1 billion operating loss on its electric and software division, already exceeding its earlier forecast of a $3 billion loss for the entire year. X struggles in tumultuous first year under Musk. Elon Musk took over Twitter a year ago, aspiring to transform it into an everything app that would surpass the platform's achievements since 2006. However, the realization of Musk's ambitious vision remains pending. It's only been a year. Post-acquisition, the platform renamed X has encountered challenges. User growth is stagnant, advertising revenue plummeted, there have been issues with content moderation since Musk relaxed the rules. Despite these hurdles, Musk claims X is growing fast and highlighted records in user seconds. The official numbers indicate a decline in daily active users since November 2022. Independent data from Sensor Tower also suggests a 16% decline in daily active users on mobile apps since Musk's takeover. While new social media platforms have emerged as potential competitors, X remains popular. However, there was a significant drop in app downloads after its sudden renaming from Twitter to X. Musk implemented significant staff reductions post-acquisition. Remaining engineers are reportedly overstretched, leading to more noticeable glitches on the platform. However, some users appreciate Musk's direction and management of X. Linda Yaccarino, X's CEO, reported a positive outlook on the advertising front, with 90% of top advertisers from the previous year returning. However, challenges persist in the U.S. advertising market, with many brands either not returning or reducing their ad spend. U.S. advertising revenue for X reportedly declined by 60% post-acquisition. The company's valuation dropped to around $20 billion as of March. Musk, however, remains optimistic, anticipating a future valuation exceeding $250 billion. He envisions expanding X beyond social media, even venturing into digital banking. Several investors, including Cathie Wood of ARK Investment Management, have adjusted their investment, though some express a positive long-term view of the platform. Musk himself has become an even more active user since his acquisition. He's now the most followed person on X, and his posts frequently stir debates among users and advertisers. Engineers have even written code to amplify Musk's tweets further. Amazon's earnings triple sales top estimates. Amazon reported a significant surge in its profit for the third quarter, July through September, with earnings tripling to approximately $10 billion. The company saw a 13% increase in revenue, totaling $143.1 billion for the third quarter. This growth outpaced Wall Street's expectations. Amazon projected its net sales for the fourth quarter to range between $160 billion and $167 billion. After a post-pandemic slump, Amazon has been focusing on rejuvenating its core e-commerce business. As a cost-savings measure, the company cut about 27,000 corporate jobs in its North America division and revamped its delivery operation to enhance efficiency. Amazon's cloud business, Amazon Web Services (AWS), experienced a stabilizing growth. However, it saw diminished demand over the past year as businesses curtailed expenditure due to economic uncertainties. Nevertheless, AWS's sales increased by 12% to roughly $23 billion in Q3. Amazon's advertising segment is emerging as a vital component of its business model. The third quarter witnessed a 26% growth in this segment, generating around $12 billion in revenue, surpassing expectations. The company has been intensifying its AI efforts primarily through AWS. In a significant move, Amazon announced its intentions to invest up to $4 billion in the AI company Anthropic. Amazon's third quarter benefited from its annual Prime Day event in July, known to bring in billions in revenue. Another event, Prime Big Deal Days, was introduced this month, which Amazon stated surpassed the previous year's similar event, indicating a robust beginning to its year-end sales. With the holiday season approaching, Amazon is gearing up by planning to recruit 250,000 individuals across full-time, part-time, and seasonal roles in its warehouses. Investors displayed cautious optimism, noting Amazon's recent hiring activities and awaiting the recovery of its cloud business. While Amazon continues to be a dominant player, it faces rising competition in the e-commerce domain. Brands with Chinese origins like Temu and Shine are gaining traction in the U.S. market due to their value offering. GM looks to improve car software by encouraging third-party apps. Following Apple's model of welcoming third-party applications, General Motors, GM recently introduced a set of open-source APIs. These are intended to allow developers to craft apps that can mesh with connected vehicle components such as windows, headlights, and infotainment systems. Open APIs can foster an ecosystem reminiscent of Apple's, where a surge in innovation was witnessed when third-party app development was permitted for iPhones. GM posits that these open APIs could pave the way for apps that offer real-time star constellation guide viewable via a vehicle moonroof, suggest thermostat adjustments based on vehicle location, or provide real-time weather alerts connected to GPS and navigation. GM hopes that their API model could set a standard for the industry. This means that a developer could create an app compatible across vehicles from various manufacturers. Despite GM's vision, realizing such interoperability might prove challenging. There's currently no consensus on standard programming practices in the auto industry. Some companies like Ford have expressed support for universal programming standards, but there's no agreement on what these standards should look like. There's a fear among automakers of relinquishing brand control if they open up too much, drawing parallels with mobile headset manufacturers of the past who lost ground to software giants like Apple and Google. Steve Crum from the industry group Connected Vehicle System Alliance expressed confidence that a consensus on programming standards would be reached. Members of this alliance include major players like GM, Ford, BMW, and Stellantis. They are currently discussing the aim of settling on a unified API approach. Despite challenges in the market, such as the decline in electric vehicle sales, auto companies still see immense value in software development. Currently, software constitutes 15 to 20% of the total engineering cost of cars, a percentage that's quickly growing. GM's push for open APIs aligns with their broader strategy to revamp their software development capabilities. They are planning to replace Apple and Google infotainment systems in some vehicles with their own software and have hired a former Apple executive to spearhead a new software division. Online returns, fees, put off shoppers. New fees imposed by retailers for online product returns seem to have reduced the rate of returns as intended. However, these charges might be discouraging potential customers as the holiday season nears. A survey conducted by logistics company Happy Returns found that around one-third of the companies witnessed a drop in their customer base after initiating fees for online returns. Even though over half of these businesses confirmed that these fees were reduced the number of products being returned, it's clear that the move also has its downsides. With the holiday season around the corner, where returns usually spike in tandem with sales, retailers could potentially alienate customers with these return fees. Last year, retailers anticipated that almost 18% of goods sold during the holiday would be returned, as per the National Retail Federation. Traditionally, retailers have been inclined to bear the additional costs related to shipping and logistics for returns, viewing it as essential for attracting customers and boosting sales. The significant rise in e-commerce sales triggered by the pandemic in 2020 has led to increased returns. Shoppers, especially during the pandemic, got accustomed to purchasing multiple variants of items to try at home, resulting in a higher return rate. For instance, the rate of online product returns rose from 9.6% in 2019 to 16.5% in 2022. Such returns add to the retailer's expenses related to shipping, storage, and labor. Retailers are adopting diverse strategies to minimize returns, such as notifying shoppers about frequently returned products, using online tools for better product fitting, and offering discounts to those who commit to keeping their purchases. Big names like Amazon.com, H&M, and Zara have introduced return fees. Many retailers are also encouraging shoppers to return items in store, hoping they might make additional purchases. According to Happy Returns, 81% of retailers had introduced some form of return fee in the past year. Amazon levies a $1 fee for returns via United Parcel Services. H&M charges $5.99 for U.S. Postal Service returns waived for loyalty program members, and Zara imposes a $3.95 mailing return fee. These fees typically don't cover the full cost of processing returns. A survey by Blue Yonder revealed that 59% of consumers admitted to stricter return policies like return fees have made them reconsider making a purchase. UPS downgrades outlook as demand and revenue fall. United Parcel Service (UPS) has revised its sales forecast downward following a decline in revenue in Q3 attributed to a decrease in global shipping demand. As a result, UPS's stock price fell about 6% to $138.17 per share on Thursday. Year-to-date, shares have already decreased by over 15%. UPS's CEO Carol Tomé pointed to macroeconomic factors as the primary culprit for the weakened demand during the quarter. Shipping between China and the U.S. has not picked up as quickly as UPS had hoped, and there has been a notable decline in online retail sales. The average daily package volume in the U.S. for UPS decreased by 11.5% to 17.3 million. Tomei observed a shift in consumer behavior, with more people spending on services like vacations, dining out, and entertainment rather than goods. Earlier this year, as UPS was in contract negotiations with the International Brotherhood of Teamsters, there was apprehension about a potential work stoppage. Consequently, customers moved their business to competitors. This diversion resulted in an average daily shift of about 1.5 million packages, a higher figure than initially anticipated. However, UPS claims to have since regained about 40%, 600,000 of this volume, and aims to recover the rest. UPS has announced its acquisition of Happy Returns from PayPal, though the purchase price remains undisclosed. In September, UPS also revealed its intention to buy MNX Global Logistics, which primarily serves the healthcare sector, for a combined total of $1.3 billion for both companies. Q3 revenue dropped nearly 13% to $21.06 billion, falling short of the anticipated $21.4 billion. Adjusted earnings were $1.57 per share after considering one-time factors, slightly higher than the predicted $1.52 per share. UPS reduced its yearly revenue forecast to between $91.3 billion and $92.3 billion from the $93 billion projected in August. CFO Brian Newman expects Q4 daily average U.S. volumes to range between 22 million and 23 million, which represents a single-digit percentage decrease from the previous year. Slowing domestic travel hits budget airlines. Despite a strong travel demand over the past 2 years, some airlines are witnessing a decline. This is attributed to an oversaturation of U.S. flights added this year and an increased preference for international travel during the summer. After the immediate post-pandemic surge in travel, typical travel patterns are re-emerging. These carriers have been most affected, losing the ability to set higher prices and consequently reducing fares to attract passengers. Spirit Airlines highlighted that the expected return to regular demand during peak holiday times hasn't materialized. This has prompted them to review their growth plans, especially after reporting a $158 million loss in Q3. Frontier Airlines, based in Denver, reported a Q3 loss of $32 million. Although lower fares stabilized its bookings, rising fuel costs are expected to impact its Q4 margins. Southwest Airlines plans to adjust its growth in alignment with current demand trends. While it has seen stable demand with strong holiday bookings, its unit revenue is forecasted to decrease between 9% and 11% in fourth quarter. Despite a 5% revenue rise in the last quarter to $6.52 billion, the airline predicts a 9 to 11% drop in revenue per available seat mile in the coming months. Southwest shares experienced a slight decline. Frontier's stock went up by 9.1%, while Spirit saw a 4.6% drop. So the article also mentioned Southwest's operational issues from the previous year and its effort to prevent such disruptions in the future. That was a fiasco. The company has raised its annual fuel cost estimates to between $2.85 and $2.95 per gallon. Price increases hurt Unilever's ice cream sales. Unilever, the owner of Ben & Jerry's, reported that elevated ice cream prices deterred consumers, resulting in a 10.1% drop in sales volume for the third quarter. An 8.2% increase in prices caused U.S. consumers to opt for less expensive store brands. The sales drop was also attributed to unfavorable weather conditions in Europe. The decline in ice cream sales, along with other factors, led to a disappointing quarterly earnings report for Unilever, causing its UK-listed shares and American depository receipts to decrease by about 3%. Despite the drop in ice cream sales, the company's underlying sales grew by 5.2%. This growth comprised a 5.8% price increase and a 0.6% decline in volumes. Unilever's new CEO, Heinz Schumacher, proposed plans to rejuvenate growth, emphasizing the promotion of major brands and launching significant innovations. However, analysts expressed doubts, noting that Unilever had previously made similar promises with minimal tangible results. The company noted that while consumer sentiment in North America remains robust, cautionary signs are emerging, including a trend towards purchasing larger pack sizes and promotional products. Unilever confirmed the sale of Dollar Shave Club to U.S. private equity firm Nexus Capital Management for an undisclosed sum, retaining a 35% stake in the razor business, but they initially purchased in 2016 for $1 billion. Schumacher stated that while significant acquisitions are not on the horizon for Unilever, they are open to selling more business units and making small-scale acquisitions. The company revealed multiple leadership changes, including the appointment of Fernando Fernandez, currently heading the Beauty and Wellbeing Unit, as the new Chief Financial Officer. Ezzy Eggleston-Bracey, the U.S. head, has been confirmed as the company's new marketing chief. Honeywell gets lift as supply chain improves. Honeywell's third quarter performance showcased a decrease in profit but an increase in revenue, spurred by surging aerospace sales and an enhanced supply chain. The company's forecast for the year has been slightly refined. Honeywell's Q3 revenue increased to $9.21 billion, up from $8.95 billion the previous year. However, this figure was slightly below the $9.23 billion anticipated by Wall Street analysts. The adjusted earnings after excluding one-time items were reported at $2.41 a share, surpassing the market's expectations of $2.23 a share. CEO Vimal Kapur attributed the notable sales growth in commercial aviation and defense and space sectors to the reinforcement of Honeywell's supply chain. During the quarter, Honeywell's order backlog reached an all-time high of $31.4 billion, marking an 8% increase from the previous year. For the annual forecast, Honeywell adjusted its sales predictions to a range between $36.8 billion and $37.1 billion, slightly narrowing it down from the previous forecast of $36.7 billion to $37.3 billion. The company's adjusted earnings estimation for 2023 has also been refined, now set between $9.65 to $9.75 per share, trimming 5 cents from both the lower and upper limits of its prior guidance. Honeywell shares witnessed a 1.1% drop, closing at $176.06 on Thursday. Intel sales fall amid PC weakness. Intel reported a decrease in its sales and profits in the recent quarter, largely attributed to weakened personal computer sales affecting the demand for its chips. The company's ventures into artificial intelligence haven't compensated for the slump. Intel's third quarter sales stood at $14.2 billion, marking an 8% decline from the previous year, but it still surpassed Wall Street's expectations. The company posted a net income of $310 million, which, although considerably lower, exceeded projections. For the upcoming quarter, Intel anticipates sales ranging from $14.6 billion to $15.6 billion, outstripping Wall Street's predictions. Intel is a leading supplier of central processing units used in personal computers and chips for data center servers. The company maintains some of its cutting-edge manufacturing units in Israel, where ongoing conflicts persist. However, CEO Pat Gelsinger confirmed the company's operations remain unaffected and a major expansion in the region is underway. Intel's market dominance has been threatened as competitors have gained ground in recent times. The company didn't experience the sales boost that NVIDIA, an AI chip manufacturer, did, particularly with the rising demand for AI tools such as OpenAI's ChatGPT. The PC sales market observed a downturn after an initial surge during the pandemic. Reports indicate a 7.6% decline in PC shipments in the third quarter, year over year. Intel's division housing its PC chips witnessed a 3% sales drop, amounting to $7.9 billion. Chip manufacturers, including Intel, remain optimistic about a rebound, especially with future PCs equipped for AI computations. Intel plans to roll out chip enhanced with AI capability shortly, and Gelsinger considers this technology pivotal for this PC sector. NVIDIA remained the leading force in AI computation for data centers. The rising expenditure on NVIDIA's chip for developing prominent AI systems has challenged Intel's market position. Despite Intel introducing its own AI chips, it hasn't yet captured a significant market share, evidenced by the 10% drop in sales, which amounts to $3.8 billion in its data center and AI division in the third quarter. Comcast subscriptions drop. Comcast experienced a decrease in broadband subscribers in the third quarter, attributing it to growing competition. However, the company witnessed an increase in profitability driven by the robust performance of its theme park sector and reduced losses from its Peacock streaming platform. Comcast shares saw an 8% dip on Thursday. The focus of analysts remains on Comcast's capability to expand its broadband clientele, a critical indicator of its growth. For the third quarter, the Philadelphia-based conglomerate, which owns the Xfinity broadband and cable services, NBC Universal Media Assets, and Sky TV Enterprise, reported a 0.9% growth in revenue, reaching $30.12 billion. The company also registered a net profit of $4.05 billion, surpassing the forecast of market analysts. The broadband segment, a pivotal growth factor for Comcast, witnessed a decline of 18,000 users out of its extensive base of over 32 million subscribers. The competitive landscape for internet services has grown fiercer, with AT&T expanding its fiber broadband coverage and mobile network providers like T-Mobile and Verizon launching 5G services which can rival traditional broadband connections. Contrary to the usual trend of gaining subscribers in the third quarter due to college students' return, Comcast saw a dip. Peacock, the streaming platform under NBC Universal, showcased improving figures with losses shrinking. The platform added 4 million premium users, summing up to 28 million in total. Universal's movie Oppenheimer accumulated over $900 million globally in box office sales during the quarter, placing it as the third top grossing movie of 2023 as per company data. However, the movie studio's revenue declined compared to the previous year, which saw a boost from the hit movie Minions: The Rise of Gru. Apple faces possible watch import ban after U.S. ruling. A U.S. federal agency determined that Apple infringed on a patent held by medical technology firm Masimo. This could lead to an important ban on some Apple Watch models. The dispute centers on Apple's use of a sensor to measure blood oxygen levels, which Masimo claims violates its patents. While Apple could appeal, make changes to its products, or settle with Masimo, the company has stated the ruling won't immediately affect its watch sales. The U.S. International Trade Commission confirmed that Apple's inclusion of a pulse oximeter in its watches since 2020 violated Masimo's patents. The Commission has prohibited the import of specific Apple Watches into the U.S., though the Biden administration could overrule this decision within 60 days. Apple has various routes to sidestep the ban, including altering the watch's software to exclude the disputed technology. Masimo and Apple have been embroiled in a legal battle where Masimo claims Apple not only stole its technology but also hired its staff to integrate a similar feature into the Apple Watch. Reacting to the verdict, Apple asserted Masimo's attempt were to block a vital product to pave the way for its own watch that copies Apple's. Meanwhile, Masimo CEO Joe Kiani emphasized that even a global giant like Apple must abide by the law. In 2013, Apple and Masimo discussed a potential collaboration. Apple even considered integrating Masimo's technology into its product, though these discussions did not progress. Court documents later disclosed that Apple internally mulled over the idea of acquiring Masimo. However, Apple, instead of proceeding with this, started hiring Masimo engineers to develop the technology in-house. Apple stated that while it did meet with Masimo, it chose not to work with them as Masimo is more aligned with clinical applications and consumer needs. Several firms have previously expressed concerns about Apple's approach, accusing it of engaging in preliminary discussions to understand their technology, but then launching similar products without establishing partnerships or acquisitions. Microsoft replaces marketing chief. Microsoft is transitioning its brand identity toward being an AI company, and as part of this shift, has announced a change in its top marketing leadership. Microsoft's chief marketing officer, Chris Capacella, is leaving the role after 32 years with the company, a decade of which he served as the chief marketing officer. CEO Satya Nadella mentioned that they had been preparing for Capacella's succession for a while and believed the onset of the AI era is the appropriate moment for the transition. This change follows the recent departure of Panos Panay, Microsoft's chief product officer. Takeshi Numoto, formerly the commercial chief marketing officer and leader of Microsoft's cloud marketing business group, will replace Capacella umbrella. For the recent quarter, Microsoft reported a revenue of $56.5 billion, marking a 13% year-on-year increase. Notably, the revenue from Azure, Microsoft's cloud service, surged by 29%, surpassing the expectations. Azure powers AI software for prominent tech firms, including OpenAI and Meta platforms. In November, Microsoft intends to launch Copilot, an AI-powered assistant for Microsoft 365. Confidence in Microsoft's AI potential has boosted its stock by over 35% this year, with the company poised to capitalize on AI's increasing prominence in tech. Stellantis bets on a Chinese EV. Stellantis is investing approximately $1.6 billion for a 20% stake in the Chinese electric vehicle company Zhejiang Leapmotor Technology, as it aims to capitalize on more cost-effective Chinese EV technology and increase its global market share. The deal allows Stellantis 2 board seats and makes it Leapmotor's exclusive export partner through a European-based joint venture. Stellantis will hold a 51% stake in this venture. This move mirrors Volkswagen's $700 million investment in Chinese EV company Xpeng. However, while VW focuses on the Chinese market, Stellantis plans to sell Leapmotor vehicles internationally. Chinese EV manufacturers can produce vehicles 30% cheaper than Western competitors, a statistic identified by Stellantis' research. Stellantis CEO Carlos Tavares emphasized the strategic nature of the investment, aiming to equip the portfolio with a Chinese EV brand that can compete globally. Chinese automakers, barring Volvo owner Geely, generally do not aim to penetrate U.S. markets due to political tensions. In Europe, regulatory challenges exist. However, Stellantis will likely face competition in emerging markets. Tavares highlighted another benefit of the partnership to gauge China's cost competitiveness in real time. This understanding could help Stellantis identify and rectify areas where it falls short. Stellantis was formed via a series of acquisitions and has a history of effectively comparing and benchmarking its acquired businesses. However, there are concerns about the viability of Leapmotors as a long-term partner given the current position in the market and expected losses this year. Drug industry secret weapon guided missiles. Pharmaceutical companies are investing heavily in biotech firms that develop antibody drug conjugates, ADCs, which offer targeted cancer treatments. This move is not only because of the potential of the technology, but also a strategic response to Medicare's focus on high-priced blockbuster drugs. ADCs function by combining antibodies with toxic agents, acting like guided missiles that directly target cancer cells, resulting in minimized damage to healthy cells. Major pharma companies such as Merck and Daiichi Sankyo have committed billions of dollars in deals related to ADCs. This is seen as a pivot away from developing or acquiring traditional blockbuster drugs that generate over $1 billion annually. One benefit of having a portfolio of medium-earning drugs is to avoid being flagged by Medicare for the price negotiations, especially under the Inflation Reduction Act. This act allows Medicare to negotiate prices for its highest expenditure drugs that don't have cheaper alternatives. They are considered complex biologics, meaning they are shielded for a longer period compared to regular drugs, 13 years after FDA approval for large molecule biologics versus 9 years for small molecule medicines. Their complexity in production might deter competition from biosimilars even after patent expiration. Merck's shift towards ADCs comes after its significant revenue dependence on the cancer drug Keytruda, which is nearing its patent expiration. With sales nearing $25 billion, Keytruda will likely be a target for Medicare's price negotiation in the coming years. Unlike drugs like Keytruda, which can be applied across different types of cancers, ADCs are typically designed for specific proteins found on certain cancer cells. Hence, each ADC targets a particular subset of cancer, which limits their revenue potential. ADC technology has been around for decades but faced technical challenges. However, advancements in recent years have rejuvenated interest in the field, attracting pharmaceutical giants like AstraZeneca and Gilead Sciences. In essence, while ADCs might not achieve the blockbuster status of drugs like Keytruda, their targeted efficacy and strategic benefits in the context of new drug pricing regulations make them an attractive focus for the pharmaceutical industry. The economy has a high bar after GDP boom. A slowdown isn't inevitable, however. The U.S. economy witnessed significant growth in the third quarter, surpassing expectations. Although maintaining this momentum in the upcoming quarter might be challenging, a complete slowdown isn't guaranteed. The Commerce Department stated that the U.S. economy grew at an inflation-adjusted rate of 4.9% annually in the third quarter, marking the most substantial increase since the fourth quarter of 2021. This growth surpasses the Federal Reserve's expectations, which believed a growth of less than 2% was necessary to prevent the economy from overheating. A primary reason for the unexpected growth was consumer spending, which saw an increase of 4% annually. Factors supporting this were a robust labor market, considerable pandemic savings, the resolution of some supply chain issues, and decreased price for certain goods. Another surprising factor was the growth in inventories, contrary to the belief that businesses would cut down. This contributed 1.3 percentage points to the GDP growth. For the fourth quarter, economists had predicted a 0.9% annual growth rate, though given past predictions, this number may not be entirely reliable. There are concerns about the continuous growth from inventories. However, with consumers purchasing more goods, businesses don't want to run out of stock. Several factors could cause consumer spending to moderate, including rising interest rates and the resumption of student loan payments. On the bright side, the job market is strong, with wages rising faster than inflation. Additionally, gasoline prices are dropping, which might redirect consumer spending towards other commodities. The article references Stein's law, emphasizing that while certain trends might not continue indefinitely, they can persist for an extended period. In essence, while the U.S. economy's recent growth has been encouraging, there are variables at play that could influence its trajectory in the subsequent quarters. Meta's new year of efficiency won't look like the old one. While Meta Platforms, formerly Facebook, recently reported strong quarterly results, CEO Mark Zuckerberg is gearing up for significant investments in the metaverse and artificial intelligence, shifting from last year's year of efficiency. Meta posted robust results for the most recent quarter. Advertising revenue surged 24% year over year to $33.6 billion, outpacing Wall Street's predictions. Additionally, Facebook and the company's other apps experienced more user growth than anticipated, with Facebook gaining 10 million daily users in its crucial U.S. and Canadian markets. Impressively, Meta's operating income doubled from the previous year to $13.7 billion, pushing its operating margin above 40% for the first time in over 2 years. However, Meta's metaverse endeavor under Reality Labs reported an operating loss of $3.7 billion for the quarter, amounting to a total of $11.5 billion for the year. Zuckerberg emphasized his renewed interest in AI, declaring it will be the company's main investment focus in 2024. For 2024, Meta anticipates capital expenditures to be between $30 billion to $35 billion and total expenses ranging from $94 billion to $99 billion. While increasing expenses might be acceptable for investors if advertising growth continues, Meta CFO Susan Li voiced concerns about the volatile macro environment impacting the ad market in the upcoming year. Following the year of efficiency, which saw Meta cut almost a quarter of its workforce, Zuckerberg plans to boost hiring in the forthcoming year, particularly in AI, addressing significant hiring backlog. Even though major tech companies like Microsoft and Google are heavily investing in AI, Meta faces challenges demonstrating how these investments will yield future returns. While Microsoft and Google have clear avenues for monetizing their AI endeavors, Meta must ensure its advertising remains effective and to fund its ambitions. In essence, after a year of trimming down and focusing on efficiency, Meta is gearing up for a year of hefty investments, particularly in the realms of the metaverse and AI. However, the company must navigate potentially uncertain advertising landscapes to finance these ambitions. Thank you for watching. Please like and subscribe if you've lasted this long. And have a great day. Have a great weekend. We have a new video coming out tomorrow.